If you are still struggling with the concept of financial and management accounting, stay tuned. So, in this video, you will discover the similarities between managerial and financial accounting. I'll give you 5 major differences that separate the two practices. I'm Themba Dlamini, your MPhET lecturer for the PDBA. Financial accounting is the process of recording, summarizing, and analyzing an entity's financial transactions and reporting them in financial statements to its existing and potential investors, lenders, in South Africa's case, labor unions, and creditors. On the other hand, managerial accounting is the process of identifying, measuring, interpreting, and communicating information to management to assist them in planning, decision-making, and risk management. If that doesn't make a whole lot of sense to you, then I don't blame you. Trying to summarize two broad practices into just a couple of sentences is a difficult task. I think it's easier to build a picture of these two branches of accounting by looking at their similarities and differences. So how are they similar? Well, like I just mentioned, they are both branches of the same tree of accounting. Accounting, which is referred to as the language of business, is a huge field of study and can be divided up into several different practices like financial, managerial, tax accounting, audit, bookkeeping, and forensic accounting. And financial and management accounting are just two of those branches, and they also both involve collecting financial information and presenting it to their target audience in the form of financial reports. But who is the target audience and what financial reports are we talking about? Well, let's get into that now as we talk about the 5 differences between financial and managerial accounting. Difference number 1, the target audience. Financial accounting, it is external audience, whereas managerial is internal. Let me explain. The International Accounting Standards Boards came up with what is known as IFRS, International Financial Reporting Standards. The primary users of financial statements are an entity's existing and potential investors, like I've just said earlier, lenders, labor unions in South Africa, and creditors. That's because the main objective of financial accounting is to report on the business financial health to these external parties. That's not to say that other groups of people like management, regulators, and the public won't find financial statements useful. Keep in mind that existing and potential investors, lenders, and creditors are the main reasons financial statements exist in the first place, to protect these external parties that are funding the business or potentially going to fund the business going forward. In contrast to this, in managerial accounting, the target audience is all internal. The main objective here is to create internal reports to help managers within the business to plan for the future, make informed business decisions, and manage risk, which in turn will impact on performance and profitability. Now let's discuss difference number 2, outlook. Financial accountants put together reports like the income statements, balance sheet, and cash flow statements to summarize transactions that happened over a period of time, or the closing balances of assets and liabilities and equity at a single point in time, i.e., in the past. This period of time or point in time that we are talking about in managerial accounting, the target audience is all internal. The main objective here is to create internal reports to help the managers within the business to plan for the future, make informed business decisions, and manage risks, which in turn will impact on performance and profitability. Looking at the future like budgets or forecasts, which determines how a business chooses to allocate its resources. Let's discuss now difference number 3, the scope. Next up, I want to talk about the scope, which is completely different for these two branches. Financial accounting, the scope is broad. Financial statements consolidate the results of all the different departments and business units so the external parties can get an understanding of the big picture of the whole business. Meanwhile, in management accounting, the scope is much narrower. Management accountants like to slice the company up into different segments, divisions, and cost centers to provide the managers over all these different areas with detailed reports to help them specifically. These reports might not be limited to financial information either. They might contain non-financial information like detailed commentaries or explanations to help support the data by telling the story. If you like, you can say the management accounts look under the hood of the car like a mechanic trying to fix, service, and conduct preventative maintenance for the future sustainability of the vehicle. Whereas the financial accountant is more like a traffic inspectorate, looking at how fast and how far the car has traveled and whether it from the outside it looks roadworthy. In other words, they look at things like the going concern, will it survive in the foreseeable future? Now let's look at difference number 4, priority. In financial accounting, the focus is always on being objective and precise. Financial statements are meant to reflect the true and fair view of the business's data and affairs at the end of the period. No guesstimates are allowed. Yes, you might argue there is obviously approximations and so on, but there's a high emphasis on precision. But with managerial accounting, the priority is on being relevant and timely. What use is a super accurate report if it comes to a manager too late and isn't relevant anymore? For this reason, management accounting gets more leeway to use estimates and approximations and shortcuts. This means that they can deliver their analysis on time. Estimates and shortcuts sounds a bit dodgy and Guptarish, wouldn't you say? Don't management accountants have rules to follow? Not really, because their reports and analysis are confidential and are for internal use only. Management accounting is less regulated than financial accounting. However, financial accounting is heavily regulated. Remember when I spoke about IFRS just now. These are the principles and standards that financial accountants have to adhere to. IFRS lays out a straight road map that shows us how we should record transactions and present that information in financial statements like the income statement or statement of comprehensive income and profit and loss, or otherwise, and also the balance sheet, which is otherwise known as the statement of financial position and the statement of cash flows. And that's no wonder really, since the users of these statements are external, they need to be protected from fraud and misinformation and fake news. And on top of that, financial statements sometimes need to be audited, obviously depending on where you are in terms of the growth stage of your company. Audit is a completely different branch of accounting, of course, which is composed of an independent external group of accountants again, whose job it is to review and check out the financial statements before they can be approved and sent out to the external lenders and investors. Now, at the start of this video, I promised you 5 differences. As a little bonus to you, not necessarily as a little bonus, but I want to just say there's also one other thing is I want us to discuss which one is better. And when we discuss this, it's almost like a Cristiano Ronaldo and Messi debate. While from sheer necessity, financial accountants, because of law, as your company grows to a certain threshold, they become essential services. You can't do without them. You are required to report in terms of the international financial reporting standards. And also there's certain requirements of the JSE. So at a certain point in time, it is absolutely crucial and essential to have a financial accountant. Yet, on the other hand, management accountants are not required at all. However, they are invaluable. So the one is essential and the other one may not be essential, but it is absolutely crucial to have them in your business. Because management accountants, they help you make the money. Whereas the financial accountants are more like they count the money. Both are important. Right. And so as we conclude, let us conclude on this, that financial accounting and management accounting are of great significance. In fact, they help the organization in various ways, as financial accounting is helpful in the proper record keeping of innumerous transactions and comparisons of the performance of two periods of an entity or between the two entities, while the management accounting is helpful in analyzing the performance, making a strategy, taking an effective judgment, and preparation of policies for the future. And I hope with that video you have an idea what is the difference between the two. I really hope that you enjoyed that video, and I'll be sending more videos, but please feel free if there's any concept of this module that you're struggling with and you specifically want me to make a video for it, please let me know. My best intentions are to serve you as best as possible, and I hope you enjoy your journey further as you ace PDBA. Thank you so much. Cheers, guys.